Good morning, afternoon, evening, everybody, and welcome back to Global LPG Conversations, Argos's podcast, which covers the latest in global LPG market developments. My name is David Appleton. I'm Vice President at Argos Media for LPG. Today, I'm joined again by Kristen Mueller, our Principal for Consulting. Hi, Kristen. How are you?
I'm doing very well, thank you, David. How are you?
Also good. Getting a little bit chilly now here just north of London. Finally, a bit of a late start to the winter, which is a bit topical because we're going to be discussing today the winter outlook for LPG. And just to kick things off with a little bit of context, the market is we're at towards the end of October now, is looking quite different to what it was 12 months ago. And unlike most other products, the price today is actually lower than it was. If we look back to Asia and Europe, we were looking at high $800, $900 per ton in October, November 2021. And we've seen quite a lot of volatility since. As we're all aware, we've been through the situation where we saw a bit of a price spike in February, particularly on the back of high crude and the invasion of Ukraine and so forth. But the market has really come down quite a lot since, and it's been really volatile. So today you're going to take us through our outlook going forward. But before we do that, can you just briefly take us through how you forecast the price for LPG in the short term?
Of course. So our starting point is always the crude market, because that basically provides the context, the background for all the refined products. Then we look at the naphtha market, and that's because we think about the petrochemical market, in particular those steam cracker operators who can swing between LPG and naphtha as basically the swing demand then for LPG. And so, when LPG is relatively cheap compared to naphtha, we would expect those petchem buyers to be buying LPG, and when naphtha is cheaper, then we'd expect those petchem buyers to prefer naphtha. And then we look at LPG-specific factors, and there's many potential factors we could be looking at, and those factors may be more or less important depending on what time of year it is or what's driving the market psychology. And we'll get into some of those factors in more detail, I think, later in this discussion.
So okay, let's get straight to that. So regarding the LPG specific, this is an LPG podcast. That's really what people are focused on. What are those and what do you look at?
So one of the very important ones we look at is seasonality. We expect LPG to be valued more highly versus naphtha in the winter months, given its role as a heating fuel. We look at stocks, we look at outages, we look at new sources of demand which might be opening up, such as PDH plants. We also will look at the downstream petrochemical sector, any number of things, but that's a sample.
Right. Yeah, I see. Yeah, so with LPG, there are of course a lot of different demand sectors and so forth, which I guess can all have an impact on the market. And then in terms of winter 22 into 2023, what are we thinking here? How are things looking?
So there's a lot going on under the surface, but I think if we were to sort of give a high-level summary, it's that there's bullish factors in the wider energy market, and those are sort of being blunted by LPG-specific factors, with the net result being a forecast which is a relatively benign LPG price environment for the winter. So in contrast to last winter, as you said, very high LPG prices, we are not expecting to see those prices sort of approaching the four-figure mark again this winter.
Okay, and then what specifically the wider energy market is the cause of this bullishness?
So that's really the crude and the natural gas markets, which are just bullish for any energy prices generally. On the crude side, OPEC Plus members have not brought all the barrels back to market, which we were anticipating them bringing as they unwound their COVID-related cuts. So that commitment to bring 400,000 barrels a day, an additional 400,000 barrels per day each month, those barrels were not entirely brought back to market. Many producers were falling quite short of their quotas. And most recently, the group has said that they're actually going to cut that quota. We will see what that's going to mean in practice, because sort of as cutting a quota that you weren't actually meeting may be a bit theoretical, but the impact has certainly been more price support for crude.
Right. And then what about the gas side then?
So, natural gas prices have come off slightly, but they still remain relatively quite high. While the exact impact is hard to measure, market impacts tell us that where other products, be it propane, be it crude, can be substituted for natural gas, then people are trying to do that. We've seen, for example, LPG as a refinery fuel increase, certainly here in Europe. And I think you've had some feedback from the marketplace as well about that.
Yeah, that's certainly true. And we've had a situation both in terms of the refineries, which are now using propane and to some extent butane instead of natural gas for their process, but also for industrial customers who have been looking at this as an alternative, which really is an indicator that there's a feeling in the market that natural gas prices might remain high, not just for a few months, but potentially longer term, say 2, 3, or maybe even 5 years. And there's potentially this idea that you could switch away from natural gas and have propane as a source of your heating processes and so forth, possibly as a primary source, but potentially as a backup when you have this situation with high prices of natural gas. And therefore, if you've got the propane infrastructure, you've got a hedge that you can use there. So in the broader picture, though, at the moment, what we're seeing, what you're saying here is we've got these high crude prices due to the cuts from OPEC in particular and the shorter market there. And obviously this situation that we've never seen before in record high natural gas prices in recent months. But we aren't seeing that in LPG. So why not? What's going on there?
So first I'll focus on the naphtha market, and then sort of the LPG specific factors. So for those of us who've been watching the crude and natural gas markets, we may have thought that those were the wildest markets around, but actually the naphtha market has been giving them a run for their money. So this time last year, naphtha prices were relatively high compared to crude. They're trading at a premium to crude for much of the second half of this year. That's unusual, and it was unusual for them to sustain that premium for as long as they did. Come the start of 2022, those naphtha values plunged, and they're only slowly recovering now. So, in the middle of this year, the naphtha crack, which is essentially the difference between the naphtha price and the crude price, was the lowest it's ever been. And it still remains really, really very low. That price collapse was the consequence of high refinery runs, and that was driven by the high demand for diesel and gasoline. If you've been following that, you know that inventories of those products have been really, really run down. The refinery runs as producing the diesel and the gasoline that everybody wanted also produced far more naphtha that can be used in naphtha's main end sectors. So in particular, as a gasoline blending stock and petrochemicals. That subject is probably enough for its own podcast, but not this podcast. Right.
Yeah, we'll stick to LPG or LPG people, but I'm sure our colleagues in the products teams have been looking at this and reporting on it, and have been recording podcasts on this topic. So anyway, headline for us in LPG that it's just been very, very weak, and that's having an impact.
Yeah, and so that's been one factor which has definitely been keeping the price pressure on LPG low, but then the LPG specific factors. So I'm just going to focus rather on a couple of those. So first, as I just mentioned, the petchem sector. So the petchem sector, can only take so much naphtha at the moment, and downstream petchem margins are really very weak, and that's also impacting demand for propane and butane. We are seeing lower utilization rates from petchem operators, extended maintenance. Some plants which we had expected to come online in the near term are being pushed out farther into the forecast period. So, some things that we thought were going to come online in the latter half of 22, we're now seeing into 2023, maybe even later.
Right, that makes sense. And then obviously you're talking about utilization rates as well. And then obviously the other thing that's really important to LPG, and specifically, of course, propane, is PDH. So putting the naphtha economics aside, I assume that's really one of the big drivers there as well.
It absolutely is. When we're sort of looking at the balance that we expect to see in 2022, 2023, so much of the increase in demand that we expect to see in those years is driven by the PDH sector, and specifically driven by China's PDH sector. And I think that's actually an area of the markets that area of the market that Argus has a really good handle on. And our team in China is speaking to the players in that market every day, and it's been really noticeable sort of over the course of the year in conversation with them how that story about the weakness in the petchem margins, how that's flowing through to lower utilization rates, how that is flowing through to the build schedule. You're definitely seeing an impact in the Chinese PDH market, and that's having a big impact on the balance and the price.
Yeah, absolutely. And I think that I think it's reasonable to say that as long as China continues with its zero COVID policy, and that has an impact on the industrial complex within China in terms of the ability to get products out smoothly and rely on it effectively as a factory for more derivatives, then we're going to see some hesitation in using it, and those margins become negative, and operations rates and so forth. And I guess in terms of forecasting, it's really hard to know when that's going to change, because it's dependent largely on government policy. It has nothing to do with LPG. Is that fair to say? Yeah. So okay, just moving it maybe a bit to the supply side and away from the petchem sector. If you can just give us one more factor among the things that you're looking at that's been important, what would that be at this point?
So, one of the things that we point to when we think about how strong prices were at this time last year was the position of U.S. stocks. Last year, the market was really concerned about it. So particularly in the early months of the winter, stocks were, below the 5-year range. People were really concerned that a cold snap or a market disruption would see competition for, those limited stocks soar. And this year, we've moved into a much better position. So stocks are continuing to build. At this point, they're almost about 20% higher than they were, at the same time last year. Production growth has outpaced exports, and so that's given the stocks a chance to rebuild. But U.S. stocks are one piece of the overall stock story. So do you think market participants are sort of similarly relaxed about stocks further down the LPG value chain?
Yeah, it's a really good question, and actually this is where I think we return to a topic that we had covered in an earlier podcast with editor Peter Wilton, is the situation in inland Europe. Because when I read into all the factors you're talking about there, they're all effectively connected to the global seaborne market, where it appears that this combination of relatively high availability and then also lower demand, particularly from Asia, has led to a glut in these lower prices. If you go into inland Europe, of course, that's a different situation, because we have these refineries which are using LPG internally. You also have, particularly in Eastern Europe, a situation where getting product from Russia in particular is more complex, still legal, but more complex, and you have some players who are not willing to take that. So you have shorts going into Central Europe, and they need to be covered by anything that's coming in particular from the US, and there simply isn't the capacity to push enough through the terminals, and consequently there really is a situation where there's a lot of concern about where we'll end up later on in the winter in those markets, because of basically a bottleneck at the gates to the European market in particular. So that's a big concern that could end up pushing prices premiums for the inland market very high. Of course, so far we're here just getting towards the end of October, we've had a late start to winter, which I think Normally, if you're a distributor, obviously you want to see people using your product. It's not necessarily great to talk about warm weather and so forth, but I think there are quite a lot of market players who would actually rather see less stress on the system this year because of that situation. So yeah, we'll see how it goes, and definitely we'll revisit this topic going forward in our podcast and other stuff we put out there.
Yeah, I think that fingers crossed for a warm winter is also something that the natural gas markets are hoping for.
Yeah, true. Okay, great. I think we'll wrap up there. So thank you very much, Kristen.
Thank you, David. It's been great.
And thank you, listeners. Do get in touch if you have any comments or feedback for us. And as ever, we'll see you at the next episode. Thank you very much.